governors from 21 ASAL counties and representatives from the Council of Governors to discuss the implementation modalities of the project. The DRIVE project is divided into two components. ZPRI, that is PTA Reinsurance Company, is the implementing agents for Component 1, managing the funds worth $75 million to deliver a financial package that includes a livestock insurance product, a saving bonus product to promote a savings culture, and delivery of these financial products through digital accounts for pastoralists. Hope Murera, the CEO of ZPRI, highlighted that the program is structured especially for drought period, ensuring pastoralists before short and long rains, where the pastoralists will contribute 20% and the government supporting by contributing 80% subsidy of the insurance premiums.
The drought we've had the last year is the worst in 40 years. So it's every year now. It's no longer when it happens. Or if it will happen. It's every year. So the pastoralists understand, and I think they are looking for solutions. And the reason I believe this is, so this project is not 100% subsidized like some of the previous projects were. The pastoralists are required to contribute a certain percentage, 20%, which is substantial. And we are only covering a number of units, right? What we call the TLUs, the 5 TLUs, which will be like 3 cows. And we tell them you're welcome to actually cover the others 100%. And we've seen that on average we have 5 TLUs now for the cover that we have, which means they brought in 2 more. So they really do understand. That bit is okay, they get it. What is most important is then to build their trust that this is a product that will serve them, that this will be there in years to come. It won't come and disappear.
The Kenya Development Corporation is the implementing agent of Component 2, managing funds worth $40 million to crowd in private sector finance by de-risking livestock value chains and supporting viable investment opportunities that integrate pastoralists to unlock livestock trade potential for the country.
So our role as KDC is to de-risk the sector in order to allow and crowd in private sector funding. As I said, the project has 4.8 billion that it wants to invest, but that is not enough to solve the problem that is there. So we are looking at putting in this money so that then we incentivize the private sector to come in. And how we'll do this, we'll implement the project through financial intermediaries. So we are expecting as we put in a shilling, they probably come with 2 or 3 into the same project, so that then the funds available in terms of this sector actually then grow, as it's an underfunded sector.
Why are we bringing in the investors? We are bringing the investors to target the investments of the pastoralists. Where you're going to target this investment, it can be in an area that you're not investing so much because you are in an area that is, with the rate-fed agriculture, you will be able to produce enough fodder. In some areas, you can produce 2 seasons of fodder. And therefore, we shall encourage those areas to invest, provided the rider is, we are supporting them to invest and they are going to support the pastoralist. Meaning, there should be linkage between your production of pasture and the feedlot operators within the ASAL counties or the pastoral group within the ASAL counties. So we shall develop a linkage between them. As we support them with the seed capital, they need to demonstrate to us that they are going to work with this particular group.
The State Department of Livestock will oversee the overall project coordination and delivery of public sector responsibilities. It will ensure linkages between the two components and coordinate implementation with the counties. Going forward, the State Department of Livestock and the implementing agent will sign a memorandum of understanding with the counties with clear roles and modalities in the project coordination and implementation. Philip Keitang, KTN News.
All right, now from that story, we are going to just get right into the discussion of the day, where we are talking about the new NSSF rates. And I'm joined virtually by Mr. Daniel Mainga, who is the General Manager, Pensions Division in Minet Kenya. Welcome, sir. Good afternoon. All right, Mr. Daniel, can you hear me? Unmute.
Good afternoon. I can hear you well.
All right, all right. Thank you so much for joining us on Business Today this afternoon.
We appreciate the invite.
All right. All right. Now, in the NSSF rates, there's been talk about this. And now, what is the potential impact of the new rates on employment? Now, when we discuss about the employers and even the employees.
Sorry, I'm actually struggling to hear you.
All right. I'm going to repeat that. What is the potential impact of the new rates on employment when you look at the side of the employees and also the employers?
Wow. Sound is actually a problem. I can't hear you.
All right.
I can only hear some noise. Yes.
All right, as we continue fixing on that, remember this pension NSSF rates that have been, it is the 2013 Act, which was put into the Supreme Court said that this is going now to take effect, and it's going to take effect this month, and we are seeing the rates moving from 200 Kenya shillings to 2,160. And last week we had the Federation of Kenyan Employers coming up and saying now a gratuity is going to be raised, and also the question of the balance between the employers and also the employees came into, it was just a very major issue when it came to this. Now, as we are continuing to fix on the sound, Mr. Daniel, can you hear me?
Wow, I can only get a few words here and there. I don't know. Are you asking about the impact of the new NSSF rates?
Yes, on employment.
All right. Yes, on employment. Yeah, I can confirm the act is now in place, at least based on the court determination of 3rd of February this year. And therefore, it means effective this month of February, really we should be contributing based on the new NSSF Act of 2013, which essentially means we are now contributing, instead of the 200 we've been contributing as employees, we are now contributing 1,080 shillings, and the employer is contributing the same for us. So really, I think that is the main change. It's divided into 2 tiers of contribution. There's tier 1 and then there's tier 2. If an organization already has an existing pension arrangement, then they can apply to contract out of the tier 2 contribution, which in a nutshell means the higher contribution then continues to come to your private pension fund.
All right.
So in terms of the actual impact, I think in simple terms, on this month's payroll, then employees should be prepared to lose 1,080 shillings, those who earn at least 18,000 and above.
All right, so employees should expect 1,000 in the payslip to just go to NSSF, 1,000, Bob, the way you've said. All right, now you've spoken about the tiers. Kindly explain what the option for tier 2 contributions mean.
Wow, again, it's such a challenge. Are you asking about the tier 2 options?
Yes, the tier 2 options.
Wow, we may have to fix the sound.
All right, I'm asking about the tier 2 contributions and what these contributions mean.
Unfortunately, it's a struggle. I can't hear you.
All right, sorry for that. We are going to just move and go to a short break while we fix on the sound. Don't go too far. We'll be back with more.